He's making his investments talk. Business standard. He's making plans for an early retirement. Business standard. She'll soon be quoted on the front page. Business standard. He's making his investments talk. Business standard. He's making plans for an early retirement. Business standard. She'll soon be quoted on the front page. Business standard. He's making his investments talk. Business standard. He's making plans for an early retirement. Business standard. She'll soon be quoted on the front page. Business standard. He's making his investments talk. Business standard. He's making plans for an early retirement. Business standard. She'll soon be quoted on the front page. Business standard. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She'll soon be quoted on the front page. Business Standard. He's making his investments talk. Business Standard.
Customers want decisions fast. You need them to be accurate. Delivering both requires reliable, timely insights. At a time when disruption is high, the future is unpredictable, and everything is digital, organizations must make real-time risk decisions to approve loans in an instant. Otherwise, customers won't just be frustrated, they'll take their business elsewhere. It's time we reimagine how we make decisions. Welcome to redefined risk modeling and decision-making for a digital era. Taking loan requests from application to approved automatically without increasing risk to create a world-class customer experience. How do we do it? A comprehensive decisioning platform that supports the full analytics lifecycle, from data preparation to model development, validation, deployment, decisioning, and monitoring. Create open, explainable models in a well-managed and controlled environment using AI and machine learning. The result is your workflow gets simpler. You make faster decisions with better data and rest easier knowing governance and auditability are ensured. For you, SaaS works behind the scenes to make the decision process faster with less risk. For your customer, the loan application is seamless, fast, and efficient. Make the right decision with less risk in every moment.
Good afternoon, and welcome to the inaugural session of Business Standard Presents De-Risking the Risk Business in association with SaaS. In this event series, the biggest on risk management in BFSI in India, we will decode the anatomy of risk in banking and insurance sectors in 5 sessions over the next couple of weeks. Thank you for being with us. We have hundreds watching this session live on the website and Business Standard's social media. And now we will visit the new Indian banking landscape post-pandemic with a keynote address by former Deputy Governor of RBI and an insightful panel discussion with Chief Risk and Compliance Officers of top banks, the Head of Risk Management Practice SAS India, and moderated by a consulting editor, Tamal Bandyopadhyay, who I will now call to start the event.
Thank you, Manish, and very good afternoon and good evening for some people, because I understand there are others also from different geographies joining us. It's the first of the 5-part series, De-risking the risk business. And on the first day, we are talking about the new Indian landscape. Post-pandemic, probably not the right word because pandemic is still on, and with virulence, the second wave. We have a wonderful panel, but before that, we are really privileged to have Mr. N.S. Viswanathan, former Reserve Bank of India Deputy Governor, and currently he is the chairman of the School of Supervision, which Reserve Bank of India has set up recently. Without much ado, I would request Mr. Viswanathan to start his keynote address and set the context for day 1 discussion. Over to you, sir.
Thank you, Mr. Tamal Bandyopadhyay. Mr. Tamal Bandyopadhyay, distinguished panelists, ladies and gentlemen. It's a matter of great pleasure and privilege for me to be speaking at the first of the series of virtual events on de-risking the risk activities in the and of course it's beginning with the BFS sector as well. Of course, it is in the backdrop of the COVID-19 pandemic, which of course, as Mr. Tamal Bandyopadhyay said, is still continuing. I therefore thank Business Standard and Mr. Tamal Bandyopadhyay for giving me this opportunity to share my thoughts on the subject. The pandemic has affected human lives, disrupted economic activities, and hurt the financial system in an unprecedented manner. India is not the only one, it's been across the world. As we speak, the second wave of the pandemic is spreading fast and deep, dampening the enthusiasm which the sustained fall in the infections and the rollout of vaccines had given rise to. Therefore, this series could not. In this brief address, I want to highlight what banks can and should do in the current situation, both to address the issues that have already emerged and those that are likely to in the future. Like every crisis, there are new lessons to be learned, there are opportunities for transformation, and there are actions to be taken to become stronger. Obviously, these actions should be appropriately sequenced. They must be initiated and completed in a time-bound manner. One of the important outcomes of this pandemic is that it tested the strength of the bank's business continuity strategies and infrastructure. While most banks have largely managed their businesses in the new environment successfully, there have been some stresses occasionally, in some cases for short and long periods. But what needs to be understood is the fact that going forward, banks should be prepared for the digital channel of delivery of services becoming the predominant and most significant mode of providing banking services, if not the sole mode. In the payment space, the digital channel has grown substantially. A report suggests that the UPI transactions value during May-November 2020 was nearly double of what it was in the corresponding period in the previous year. In pre-pandemic days, the digital channels were used by customers as a matter of choice. But now, it has turned out to be even a matter of compulsion. The compulsion comes from two sources. One, the customer being unwilling to physically move out of her house. And second, from banks planning to scale down the physical presence of their staff As I speak, in fact, I was going through an IBA, a news release which said that IBA has advised its member banks to take a decision on what levels of staff should be working in their branches. So there is going to be this impact in terms of how banks operate. But in this background, let us look at there's an ACI worldwide report which says that India's journey of creating a digital financial infrastructure has been characterized by collaboration between the government, the regulator, banks, and fintech. This has helped to advance the country's goal of enabling financial inclusion and also provided rapid payment digitization for citizens. The pandemic has further accelerated the adoption of digital payments with many first-time users. I want to emphasize many first-time users adopting digital payments and significant uplift by merchants. So what does it mean? It means that there is need to scale up capabilities of digital delivery of products and services, and consequently of ability to operate in such an environment. With the digital platform becoming the predominant mode of service delivery, the control functions need to be juxtaposed with such operations. The control system should provide for generating information that is auditable on a real-time or concurrent basis. Even as I speak, I'm fully aware that many of the banks have such capabilities already, and they are being put used to by them. But I'm highlighting this here basically because I perceive a substantial increase in the quantum of transactions and the complexity of activities that will have to be undertaken in the digital mode going forward. I also see a need for substantial investment in technology being driven by the operational efficiency imperative. The stress in the credit portfolio and the need for rehabilitation of pandemic bruised businesses would squeeze banks' margin. The need for making provisions for bad assets would take away a substantial part of operating profits. This calls for increasing operating efficiency to bring down the cost-income ratio and increase staff productivity to boost the bottom line. One way, or I would say the only way to do this would be through enhanced use of digital technology, not just for operations, but also for decision-making process, and consequently for analytics in the decision-making process. This in turn calls for use of artificial intelligence, machine learning, and big data processing in the normal course of business of a bank at a scale that they have not been used to so far. Banks can, of course, opt for a proper mix of insourcing and outsourcing of these activities through collaboration with fintechs, etc. But in choosing the latter, that is outsourcing, they must contain the operational risk that can emanate from improper vendor choice, poorly drafted service level agreements, and weak backstop facilities that can lean on in the event of the failure of the outsourcing company. In areas where it resorts to insourcing, a bank will have to go in for staff being adequately skilled and ready to work in such an environment. And as such, they have to spend time and energy and effort and resources on enabling their staff to skill themselves up to the requirements in the new world. I mentioned that customers will be using the digital channels out of compulsion. And as I said, it has been pointed out in the Asia Wide World report that there are several first-time users of the digital channels. This could result even in the less tech-savvy customers tapping the digital platforms for availing banking services. There are two dimensions of this development that banks will have to be alive to. First, given the vulnerabilities of the less informed customers, the digital platform has to be quite robust with strong firewalls to prevent it being attacked by external sources. There should be warning signals to notify suspected data or access breach. I have heard that there have been instances of cloned debit or credit cards of a customer being used in multiple locations within a small span of time, not noticed by the system of the bank. Second, a robust IT system should go hand in hand with enhanced customer awareness. Banks should therefore engage in promoting customer awareness with well-designed interventions. What I'm saying is that this cannot be just a compliance function. I mean, a well-aware customer is as much important for the safety of the bank as is to the customer himself. So these are, while there are opportunities, the way it is seized, the way it is used is very important, and that is very much in the hands of the banks. The inherent strength of a bank is provided by the adequacy of capital in relation to the risk in its books. The normal principle is that the regulatory capital is maintained to cover unexpected losses. There's a detailed speech I made on this at the XLRI. If people want, they can refer to. And I have actually kind of pointed out a situation like what is happening today in that, where an unexpected loss is arising due to a similar event happening across a customer base of a bank. But the normal principle is that, but what happens is, while the unexpected loss is to be covered by regulatory capital, the expected losses should be provided for. Now, what has every crisis told us? Every crisis is telling us that there are more unknown risks than the unexpected losses for which we are providing. The global financial crisis talked of how systemic risk can impinge on capital requirements. And what the pandemic is saying is even more, which is that the risk to the financial sector can emanate from economic consequences of a non-economic event. Look, pandemic is a non-economic event, but the economic consequences of the non-economic event is what is creating the crisis in the financial system. And obviously, none of the earlier risk management systems would have anticipated this. But what I'm saying is that regularly, newer and newer sources of unknown and unexpected risks are being thrown up by each crisis. The pandemic brought to the fore that the regulatory capital that has been mandated to be maintained is not sufficient to deal with such situations. Because of which, what we see is globally a practice of regulatory forbearances on recognition of delinquencies, and even in some cases, in some of the jurisdictions, they have even allowed drawing down of the capital conservation buffer at this time. So very clearly evidence that the regulatory capital that was prescribed was not adequate to meet such an event. This is why the lessons that we need to learn from this are important. Now, I would, in this context, I think Governor Sri Shaktikant Das BI, in his address of August 2020, I think it's the 20th as well, highlighted the need for banks to subject their books to a severe stress test and raise capital well in advance of the impact of the pandemic being felt on the books after the regulatory forbearances cease. The report on the trend and progress of banking has cautioned about the large quantum of stressed assets not recognized due to the regulatory forbearances. I therefore feel that banks should take serious note of the governor's advice and take urgent action so that the shock absorbers are in place before the shock is felt. The recent Supreme Court judgment has cleared the air for a more objective assessment of the delinquencies. Incidentally, of course, it is heartening to note that several banks have embarked on capital raising, and there are talks of front-loading the recapitalization of public sector banks. As I mentioned earlier, the inherent strength of a bank comes from the adequacy of capital, in relation to the risk in its books. This calls for strong risk management practices in banks, which would ensure that risks are taken in line with the bank's risk appetite. The risks are properly measured and managed so that in the event of the risks materializing, it has the requisite capital to absorb the resultant loss. I do not want to dwell in detail on the entire gamut of issues surrounding risk management, because there is an eminent panel of chief risk officers which will be discussing this issue in greater detail later. But I still felt this address would be incomplete if I do not touch upon some important aspect of risk management in the current context. The pandemic has brought a new dimension to the risk management framework. The fact that a non-economic event has the potential to hurt the financial system deep and hard. Of course, nobody could have, and in fact, none has been prepared for such a shock, which is why globally there were relaxations to the prudential framework. But let us, however, be clear. The pandemic has elevated all three sources of risk: credit risk, market risk, and operational risk. Credit risk is higher for the obvious reasons of potential increase in default. The concern about uncertainty of economic recovery in the wake of the second wave of the pandemic has been voiced by the governor in the just released minutes of the MPC. The future performance of the restructured accounts is also uncertain. The market risks are emanating from hardening yield and uncertainties about the future trajectory, more so given that the economic recovery in some of the advanced economies has already started. The increase in the use of digital channels and technology, while cost efficient and really effective, increase operational risk concerns. The liquidity risk has been kept in check due to RBI's support, but there would be outcomes for market and liquidity risk as and when the excess liquidity is unbound. The governor has said that he will do it at the appropriate time, but it will happen at some time on the way. So in my view, the regulatory relaxations that the Reserve Bank was allowed in the wake of the pandemic were necessary and reasonable. It is an unprecedented situation and therefore required non-conventional approach to finding solutions. These, combined with the fiscal measures taken by the central government, moderated the adverse impact of the pandemic on the economy, common persons, and the financial system. Having said that, I would want bank managements to find ways to address risks without regulatory exemptions. Banks were prone to seeking deferment of recognition of NPAs when the credit risk is elevated, asking permission to move investments to STM portfolio when market risk materialize, and also have often wanted more time to recognize large losses in the event of an operational risk materializing in the form of frauds. Delaying the recognition of materialized risk is a disincentive for proper risk management. This has been articulated in a paper published by Capital recently. I would request you to go through that. So in this background, what I would say is that banks should therefore rework the risk governance structure, ensure de facto, not just de jure, independence of the risk functions, and enable the three levels of risk management to perform their assigned responsibilities effectively. Banks should revisit their sensitivity analysis that credit proposals are subject to and imbibe the learnings from the pandemic in the risk management framework. I'm sure this will be deliberated in the following panel discussion and the future sessions as part of the series. I'm also confident that the series of virtual events will enable the stakeholders to draw up action plans for the banking system to emerge stronger and resilient and to more unknown risks if they unfold in the future. I want to end with one message as a sign off. It is that we must get prepared for more unknown risks because the financial system has been hit by one crisis or the other with a disconcerting regularity that it would be inappropriate to pass each such incident as a one-off event. The effort and objective should be to be as crisis-proof as possible all the time. Please remember, it costs less to prevent a crisis than to deal with it after it has hit. Thank you for it.
Thank you, Mr. Viswanathan. Not too many keynote speakers actually stick to exactly 20 minutes, which you have done. And it's always very clinical, very precise, and very candid. And the risk managers and the compliance managers who are on the panel may not have liked everything what you have said, but I loved it because you have actually set the context of it. So now welcome to the first session of De-risking the Risk, the new landscape of Indian banking. We can't have a better panel than this. There are 4 bankers, one of them from the small finance bank. So we will hear from him what's happening in the informal sector, particularly SMEs and MSMEs and retail borrowers. And then 3 of them are from different categories of and different sizes of private banks, old and new. And if you complain that, oh God, why don't you have a public sector bank here? Yes, we have. In fact, Mr. Deepak Kumar, who is the Chief Risk Officer of RBL, has a long innings with State Bank of India. So no complaint, and to top it as a bonus, we have got one gentleman, Jitesh from SAS. I don't need to introduce SAS, which is a global fund. Is everything what Mr. Viswanathan was talking about is all about managing risk through data analytics and other stuff that they do. So 4 bankers will give us the stories of the banking industry, and Jitesh, I will use you as sort of knowledge partner. Will ask you as an outsider insider, what's your perspective on that? My job will be to speak the list because the audience is waiting to hear from you. Let me start with a very brief intro, and then I would love to have maybe 3 or 4 rounds, a small 2.5-3 minutes each kind of thing. We'll try to restrict ourselves for 1 hour, at best 1 hour 10 minutes. So by 5:30 we'll sign off, by 5:30, 35 latest. As Mr. Viswanathan said, that we are into sort of into trouble, into problem with which spilled over to on the economy from a non-economic event. Before that, 2008, we had seen the global crisis where an economic event got into on the banking turf, and what we had gone through. All of us know that. And after that, it was not a very happy scenario for the Indian banking system. Reserve Bank of India did AQR, asset quality review. We were laden with huge non-performing assets, and then dollops of recapitalization fund, etc. That got into us back to the health. And sometime by February 2019, February 2020, we were talking about that we are out of the woods. The NPA bad loan recognition is over. Now we will be in the resolution part. IBA was firmly placed, and then COVID hit us. And then we found a combination, the combined effort of the government and Reserve Bank of India to keep financial sector stability and to keep the banks going. Reserve Bank of India cut its rates, policy rate at historic low, lower than what we had seen post Lehman crisis. And also there are lots of liquidity windows under different names. LTROs, TLTROs were open for different sectors so that banks can get money and pass on the money to others. Government announced a series of packages under the Atmanirbhar scheme, and one of them, which is particularly important and significant for the banking system, is the 3 trillion government guaranteed package. To the best of my understanding, is about 2.5 trillion have already been sanctioned and 2 trillion been disbursed. So that was the scenario till about a couple of months back. And had you asked any bankers in January or even February, they would have said that, look, the scene is not as bad as we had presumed. Reserve Bank of India's biannual health checks projected that banking systems NPA could go up as much as to 14%, but bankers were confident that no, it would not. And as we speak, by 31st March, probably we would see another 2 trillion plus NPAs. So it's about 9.5%. For all these reasons we discussed, then there was moratorium, and of course there was a restructuring under the Kamath Committee, 26 sectors. But things have changed in the past 1.5 months, past 4 weeks. The second wave of COVID is it looks like more severe than the first wave, and many of the analysts believe that our ability to tackle it through fisc and through banking channel is limited. The only medicine to tackle this we have is that the only way to tackle this is actually the vaccine. That's all. And incrementally there could be a little bit of done, but most of it we have already done it. So this is the context of the new landscape. And let's start with who do we start? I think we'll start with RBL. Mr. Deepak Kumar, we'll start with you. Because as I said, you had a long experience with the Reserve Bank of India. So we will not talk about what RBI has done, what government has done, what can be done. For all the bankers, we will hear you. The first, the event is a sort of black swan event, and none of you were prepared for it. What kind of changes you have made in the operating model to tackle the onslaught of COVID? And you continue to remain an essential service provider. So what are the key takeaways from that past 1 year that you have done? Mr. Kumar, Deepak sir.
Thank you, Tamal. Good afternoon and good evening, everyone in the audience. With my experience, what I can share here, in fact, after hearing Mr. Vishwanathan, it is a real challenge to cover anything that he has not covered in his keynote address, but I will try just to give some of my experiences. COVID is slightly different from the black swan events that we were experiencing in the past. In fact, it is a double black swan event, I would say. One affecting the general health of the population, and the other affecting the economy as a whole. As a banker, we always used to manage our risks based on the reservoir of experiences that we have of the past events happening in our business profile. But this COVID has in fact nullified most of the experiences, and so many new things have happened that historical data has become practically less effective, if not completely effective. So any risk management model that bankers use is not likely to predict the similar confidence level, any risk that it cannot be predicted with the same confidence level which we used to predict in the past. All the artificial intelligence and machine learning languages depend on how the consumers have behaved in the past. Post-COVID, the basic cultural behavior of the consumer have changed. They are not going out of the home in most of the times. They are a bit scared. They don't know whether they need to earn a lot because their demand has come down. At the same time, on the banker side, they are in a fix how to serve the customers. We need to change the basic service model to keep in tune with the new consumer behavior that we are having today. And banking industry basically works for the masses in general in the retail area. We have been able to or we in the past also, we have been able to handle large account stresses in a different manner effectively. But to handle the retail customers' risks lying in the retail portfolio is a different ballgame. Most of the customers still trust physical banking, and they have more confidence in the physical banking rather than the digital banking. Their knowledge space is also limited in that area. On the banker side, we have to, in fact, what we are doing, in fact, we are trying to make a right mix between the physical and digital transformation of the banking services to suit all kinds of customers. Many need some advisory services that we have to provide on a different platform. And at the same time, we are moving, or most of the banks are moving on a digital platform to provide as much of services as possible on a digital way, in a digital way. We are still learning how to work from home. In fact, as Mr. Tamal was telling, I joined RBL Bank only 1 year ago. And during the same period, there was a complete lockdown in the country. So that was my first experience to work from home in the banking industry. Before that, a banker had not experienced how to work from home. We were always comfortable in talking with the customers person to person, listening to his body language, understanding his needs, and maybe covering his demands effectively. So this has created another type of risk in the system. We were not tuned with the digital way of working, virtual way of working. We were very protective of our data in our system, which used to lie within the system of the bank. And now that data is being transmitted from one channel to another channel. Of course, we are trying to protect those channels, block the data within the risk walls, firewalls of the systems. But still, new type of risks can happen that we are not very sure of how to handle that. Every bank has a different risk appetite, and we have to work within those appetites. I can't prescribe, or I can't say every bank will be doing the same thing, but it all depends on the risk appetite every bank is having. My experiences are with SBI, but yes, in RBL, I can't say that I will be doing the similar things that I used to be accustomed in doing in State Bank of India. Here, the things are different, and I have to. So
yeah, okay, Deepak sir, thank you for your observation. So essentially, you are saying the biggest challenge is the interface with the customers and meeting their demand. So let's hear Wilson. He represents another bank which is predominantly in the south, even though it has all over national presence. And data leakage, etc. You are talking about. We will hear Jitesh. He is an expert on that. We'll hear when his turn comes. So let's hear Wilson. What's your essentially? What are the key challenges during this COVID period at the operational level that you have seen?
Thank you, Tamal, and good evening to my co-panelists and the audience. What we have been doing in the past, in the pre-COVID period, what risk management we have been doing, we are doing in the same manner, in a more refined and more structured, or a slightly different way. But the basic manner we do the risk management is remaining the same. Though this is an unprecedented thing, COVID, nobody expected something like this, a health or a life issue taking a turn of an economic issue and impacting the entire world. This was not expected, or nobody predicted this. But this is, we were prepared for that, because that is what is risk management. We can predict something unexpected, some unexpected loss and some tail events. Always we can predict and be ready for that. So for me, This is a different thing. Of course, this is a different COVID induced disruption, COVID induced impact in the economy, sectors, borrowers, everything is different from the past. But basically, risk management remains with its essential characters. What we have been doing, or all banks have been doing during the past 1.5 years, there is added focus on asset quality monitoring, and monitoring liquidity, capital adequacy, and of course, cyber security. Cyber, we have seen Mr. Vishwanathan and Mr. Kumar already dealt with it, cyber, because of the increased digital transaction. What was seen as a comfort in the past has become a compulsion. It was a convenient mode of transaction. Now it has become a compulsion, because it is something mandatory. You can't go out and you can't go to the bank and do transactions. So cyber is an increased risk. Every bank, every financial institution, every risk manager is giving a lot of focus on data security and cyber security. Then coming to asset quality, it has become a challenge. It has become an added challenge because of the COVID disruptions. Supply chain disruption, the lockdown, countrywide lockdown fast. Then with the second wave, localized lockdowns in many areas and many key and critical geographies. And if it is continuing like that, it may things may go bad. So we have to, what we are doing, what every bank is doing, what the regulator has been asking the banks to do, is to go for close monitoring, keep a close eye on segments which have been badly affected, do stress testing, go for frequent stress testing to impact the to assess the impact. That we have been doing. And then from that assessment, from the outcome of your stress testing, you are arriving at the capital adequacy. Even the bad things are happening, even the worst scenarios are going to be a reality. What will be the capital position? What will be the adequacy? Whether there will be sufficient capital to meet the expected and unexpected loss and unexpected loss. And if not there, you have to raise capital and find ways and methods to raise capital and be ready for that. I think every bank is doing that. For the last 1.5 years, there is regulatory guidelines, and the bank's own internal process are going on in that direction. Then another important aspect under COVID special risk monitoring is liquidity management. Liquidity is very important. Because anything can happen. Your liability can suddenly fall. That flow of liabilities deposit can fall to a very dangerous level, or something may happen, something disruption may happen, and that may distort your asset liability management. But so far, I'm sure banks in India are doing it very good, managing it very well, and so far there is for liability side there is no threat also for my bank and other banks also. Liability side, thanks to the less spending and non this discretionary spending, people have not started. That is the feature. That is the in every crisis. That is the way people behave. They don't spend money on luxury or non-discretionary things. Our spending is limited to essential things. So there is plenty of money in under savings, and there is plenty of funds with the banks. So there is no liquidity issue so far, but it is under constant watch and monitoring.
Thanks, Wilson. So stay liquid, stay well capitalized, and keep a sharp eye on everything else. That's from Federal Bank Chief Executive Officer. Let's ask Ravi. He represents a small finance bank, Jana Small Finance, and Ravi is the compliance officer. So this comes under compliance, and you are into a little slightly different segment than what Deepak and Wilson are. So can you tell us what are the key challenges in managing the customers and what are the key lessons that you have learned in this past 1 year? Ravi.
Thank you, Tamal, and thanks for the opportunity. I think the challenges, I guess, are the same for most banks, but where we are, or where the small finance banks and the NBFCs who are lending to the microfinance sector, biggest issue is that we are dealing with a large informal sector. We are dealing with the MSME sector where 90% are micro enterprises. So these are very dependent in terms of how the larger economy performs. Most of it is cash-driven economy. Most of them are dependent on large industries who are there, integral part of the supply chain. And there also we have seen consumption going down, retail consumption going down. So these are small mom and pop shops, the grocery store, the tailoring units, who have seen their demand go down. Plus the lockdowns which had impacted them in terms of their businesses. Other issue we saw these units were facing were the migration of labor. So when the lockdowns happened and the labor migrated, so they were not able to carry out their normal day-to-day activity. Apart from that, capital, big issue in terms of them raising capital from the formal sector, because most of them, as I said, were informal sector. They wouldn't have that collateral or the balance sheets to support their raise for capital. So we've seen that to be a big challenge for them. The policies of both the RBI and the government have helped to a large extent. And as you can see, the focus has been largely on the MSME and the small sectors. So that has helped a lot. But as for individuals are concerned, that's again where a large number of borrowers for NBFC, MFIs and small banks are concerned. There again, the urban population, urban poor, did lose their jobs, they had to relocate. It's not that from a bank's perspective, it is not that the customer is not willing to pay, but it's more his ability to pay. Those were the challenges. Technology is, of course, a challenge for all this entire sector to be like large industries. But overall, I would say the sector has been impacted quite seriously, and they have been coming out of it with all the policies and the framework in place. We'll have to see how going forward, what happens given the limited localized lockdowns which are happening, how the sector can cope up. And then there's been liberal refinancing schemes which have happened, which has also helped the sector in various schemes which have helped the sector in putting their feet back. So I think overall, not too bad situation, but yes, something to watch for.
Thanks, Ravi. And if I've read your comments correctly, I think the key takeaway is this: probably the urban pockets are more challenging than the rural India because of job losses and migration, right?
Right.
So last among the four bankers, I've kept this gentleman at the last, not for anything else, because your name is most difficult to pronounce. Ramasamy Mayappan. Okay? I hope I have not distorted your name. So, Mr. Ayappan or Ramasamy, tell us your take. First take, we are talking about the challenges in terms of managing the customers as an essential service provider. That's the first round.
Thanks for that. Good evening to everyone, and thanks for giving me this opportunity. So, it's about 13 months ago when the real lockdown started, and when the lockdown started, it was protecting human capital, which was both customers as well as our own people. That is critical to look at, because you suddenly found an empty office, and you could not let customers come to branch, but you had to service them. So how do you keep your branches open was one of the initial challenges. Keeping in mind the local containment zones and etc. And also the digital channels. How could we activate the digital channels? How could we educate our customers to participate in deposit placement with us, do video KYC? So a lot of activity on the customer side came about through activating the digital channels, getting our own relationship managers more savvy about it, as well as about educating customers. Similarly, came to the point of collecting of your receivables. For example, there were customers had never defaulted, but due to the COVID situation are not paying on cards. So suddenly the soft calling method, earlier used to be a hard calling where, you had a collections person go. How did you get them to call on a phone? How did you get video? We made videos released to them to let them know that your interest rates will pile up if you don't pay. So there's a lot of activity that had to happen initially to get customers educated about what is a moratorium, what could be the impact, how could their credit history get impacted, and for which a lot of activity had to happen within the business team, the business teams, to be able to get the customers, understand the implications, as well as for the bank to ensure that it's able to collect its dues. Along with that, the important part that came about was to keep adequate capital and liquidity, which my colleagues, my peers spoke about earlier. So we went about, talking to investors and raised capital at the right time, so that we had adequate capital. We also resorted to taking adequate provisions because we knew this uncertainty could persist. Because when we did our stress tests, it was a lot of guess estimates in April last year when we didn't know how serious the implication could be. The entire rural India was not accessible, and we have a large part of our business in rural India. So we did a lot of stress tests, and we came up with certain numbers based which we raised provisions and capital. When we look at it in hindsight, rural India performed better than urban India in some of, especially if you look at microfinance or our vehicles finance sectors, they did maybe better than what we thought. We have to see how they play out in the second wave. But urban India suffered a lot on unsecured, where you found clients who have never defaulted on a card were defaulting for the first time or not paying their dues. So it was a big change in underwriting models had to be done to ensure that we continue to keep our book grow at a reasonable level. It was not a growth phase in the first 2-3 quarters, but we managed to keep our book flat. But to grow, we also had to change all underwriting models. Our committee approaches used to meetings became digital. A lot of changes had to happen, and we had to provide VPNs access to a lot of our employees who had never used it. So for security reasons, which means our IT teams had to work overtime. We had to shift them to hotels and other places to keep them safe, like which the Reserve Bank of India had done at that point in time, I remember. Similar process we had to do so that we could keep our bank's infrastructure running. So it's been quite a journey, a lot of learnings. We've been asked questions in meetings by directors about stress testing. Stress testing never taken into account a pandemic. It always took into account this will 10 companies will go bad or capital. How much will the capital get impacted? So a pandemic stress testing is something which is challenging, and rating agencies are overactive. So you had a lot of education to do, which as a risk manager, along with my senior managers in the bank, had to do for investors to give confidence to to staff, to customers, to our own thing. So it was quite an exercise over the last 13 months, but a lot of learnings which we have institutionalized now, and hopefully we will be able to better manage going forward. But there's a lot more to be done, especially on the digital front, and we are really working very hard on that.
Thanks, Rama. You actually echoed what Ravi said, that urban India is far more challenging than rural India. And last speaker is Jitesh. Jitesh is not a banker, but he watches banks, the entire banking system from a different perspective. His company handholds them and helps them for risk management. So Jitesh, can you tell us from your global experience also, how do you see the key challenges for the Indian banking sector, both for the customers as well as the banks?
So, when we talk from a global perspective, the first thing which we noticed or we observed how globally people were seeing this event. So they were, as Deepak sir said, they were seeing it as a series of black swan events. It's not a one-off event, it will happen once and it will go away. It's a series of black swan events, and you have to prepare in long term from that. So that was the perspective which we got when we were talking initially to large banks. This is something which is going to stay with us, and we have to prepare in long term for this. And there were a couple of, in terms of what kind of conversation we are having with the banks in general, globally or in India, there are 3 or 4 key themes which are emerging out of it. One of the key themes is, transforming the customer experience. Like, previous panelists have stated, there is a migration to, digital channels, and, banks are reassessing their channel mix in terms of physical or digital, what to put where. And the second thing is, with this migration, there were a lot of new requirements coming on. banks started expanding their data sources, their analytical capabilities, so they can provide their credit decisioning or, offer personalized offer to customer on a real time, like whether you can combine your information about the customer from your traditional channels and from your, social media or other channels and give them offer on a real time. The other theme which we also found what banks were working on is cost efficiency and innovation. So one of the things which, banks were looking at, embark on the digital journey. What are the processes we can digitize? What we can automate? Now with digitization and automation, there is a risk which comes with segregation of duty. I think so we talked about it. There is enhanced cyber risk, with a lot of online transactions happening. This we touched upon, and there is a cyber risk which needs to be managed. But the other aspect which we also found people were talking about segregation of duties within the bank itself, so that there is proper process control. So we are having a lot of conversation with banks on something like business continuity, something like automation of GRC, automation, business process automation, something like someone touched upon the entire modeling process also has to be checked. How we build model, how we calibrate model, how we deploy model. So automation in this area, digitization in this area. The third thing which we also found is increased use in analytics. And this is a trend which we notice globally as well with banks in India. So there's a wealth of information with the banks. Now I want to use this information for various data-driven decision making. And it cuts across field. It definitely cuts in the risk management side. It cuts in other areas of entire customer cycle management. The fourth thing which we were really apprehensive, when this pandemic kicked in, we thought what will happen with risk management, because I am heading a risk management practice. What will happen? Bank will see. So what we see is there is increased investment in risk management. A lot of banks are now investing in modernizing their risk platforms. They are demanding faster service, faster execution. They want their liquidity results faster in the morning so that they can take better decisions. Investment in AI ML platforms, more investment around what kind of credit decisioning you are doing, how you are managing, you are doing your portfolio analysis. Early warning systems is no longer, rule-based early warning. We are seeing signs people want to use advanced analytics into it. But the broader theme which we have seen is this is something which is going to stay for a longer period. It is a series of events and we have to make transformational changes. So the changes which are being brought about with this pandemic is going to stay with the banks. So that's essentially what we are hearing from the banking sector and what kind of conversations we are having both globally and locally.
Okay, thanks Jitesh, thanks. You actually summed up everything, and hold on, I will start this round with you. Before that, I'll tell all the panelists, there are many questions which are coming to me till now about, it's 24 plus questions have come. I think as we progress, there'll be many. So if we want to take at least a few questions to be fair to the audience who are listening to you and asking. So let's make it a little briefer, shorter kind of thing. We have a briefing and all. So let's have a little briefer round. We have another 35, 40 minutes odd left. So let's keep some time for a few questions. Now, second wave of COVID, what we have seen, I'm not a doctor, but we see that empirically more younger people are more affected, and so they need to confine those who are bold enough and going out of home, they need to confine themselves home and all. And that brings us to the digitalization. Actually, yes, we have already taken rapid strides. We heard Nandan Nilekani, what he said. He said that what would have taken years now taken weeks. That's how we do it. So in this round, I will ask each of you to talk about digitalization. But before that, I will ask Jitesh, from your sitting in your part, how do you say, where is India's bank when it comes to digitalization? Very briefly tell.
So I'll start briefly. So each bank had embarked on the digitalization journey prior to COVID also. Now what we have seen, what we have observed is the pandemic has accelerated that digitalization journey. And digitalization means different for different banks. Our small finance bank, our public sector bank, or our mid-sized private sector banks. Every bank is at a different stage of its digitalization journey. So basically what we are seeing is people are looking at digitizing their processes. They are looking at building automated system, going into some kind of paperless mode. And basic, reason for digitization is efficiency, innovation, cost reduction, and something to deal with, where most of your workforce is sitting from home. You will have your bare minimum of people who are coming to the office. So with that increased digitization, what we are also seeing is people are also talking about segregation of duties. So if we are working in an offline mode, whether we are properly risk managed, where there are proper process controls in terms of segregation of duties is also emerging as a key thing. And then when we are looking at digitization of processes, again, one of the things which we notice, and again, that was kind of a surprise to us, people investing very heavily in digitization of their GRC process. What are the processes which I can automate? How can I make these processes, my entire model governance processes more automated? And we also have, series of conversations, both on the private and public sector side, where people started talking about business continuity, how we are looking at business continuity. Is this business continuity good enough for us for the second round of wave or not? What happens if this pandemic continues? So this is in brief what kind of conversations we were having on the digitization.
Okay, thanks, Jitesh. Now we'll hear the four bankers. How did you see the past 1 year when it comes to digitalization? Like, was it a breakneck speed? What are the new products and processes came? Whatever you want to speak. I'm not insisting that you must speak about your bank, but feel free. If anything you have done out of the world, which people should know in terms of products and processes, and overall, very brief, 2 minutes each. We'll reverse it. So we'll start with Rama.
Yeah, hi. So for us, in the digitization process, what happened is productivity and efficiency became the keywords. How do we operate in the environment? Because cost control was critical to preserve resources for the bank. So because of which we looked at how we could automate various processes. So automation is one and analytics is the other. So automation of process was, could you get all your credit proposals digitized and put through a system so that you instead of having anything manually done, so that you can use the data, which then flows into early warning systems, which we again developed along with a fintech company, which we expedited during the year. Where the rule-based, which you can identify, looking at your GST network, looking at others. So, you enhance a lot of credit measures or risk measures through that digitization and analytical process. Similarly, there have been a lot of processes on bots and others being utilized in our trade shops where they've done it, or, invoices, or looking at LCs and things. So, there's been we've expedited a lot of things which would have taken a couple of years, 2-3 years. We're trying to get it done very quickly, and also trying to do a lot of digital lending, which will be more efficient, which will be with more rule-based, and digital execution of documentation, which we kept discussing in the past, but now we have reached a stage where we can get it executed digitally, and we can show them digitally, through an NESCL rather than physically have storage space. So a lot of discussion has gone around on how to automate process and how to get the analytics out of that. How do I pre-fill the data for my regulatory reporting right from my digitized data? Rather than earlier it was manually dependent on. So a lot of work has happened, and it's happening faster. But the challenges are that all consultants are busy. Hardware is a challenge to get where you require. So that's also because everybody is wanting to digitize, right? So there are a lot of pressures on, we have to manage the cost. But otherwise, it's been 1 year where there's been a lot of activity because of the productive and efficiency theme that we're driving.
Thanks, Rama. So is digitization rather, for banks as well as for your customers, right?
Yes,
for the customers, it's faster, it's less time consuming. For bank, it's more cost effective.
Yeah, we're like talking about lesser time even on a mobile banking, but how many seconds do you reduce?
Absolutely.
That's going to a lot of the data into that. Put everything
Absolutely. There. Ravi, I would like to hear you now, because you are in a space where the MSMEs and SMEs and retail customers were very different. So how easy or how difficult is digitalization in that space? And what are you doing?
It is not difficult, Tamal, and we'll be surprised by the number of people in this segment who are using smartphones to do their transactions. And when I echo whatever Ramu has said, and the Deputy Governor has actually said that you're seeing the increase in digital transactions, etc. So I think what COVID has done, the digitization journey was ongoing by all banks. What digitization has done, what COVID has done is only hasten the process. So now we are now used to a world where it's a more or less contactless customer, or non-face-to-face customer. So we have a video KYC, which has brought in a huge amount of change in terms of sourcing customers on the liabilities side. Then you have using QR codes, using all also techniques for collections. Then you have also another aspect, as somebody spoke about cybersecurity. A lot of investments banks are making in terms of tools for eliminating or reducing fraud risk. One of the things of COVID is the increase in digital transactions, which brings an element of fraud risk. So banks are investing a lot in these tools. Again, machine learning, artificial intelligence, very critical to run the op shop, and we see that being increasingly used, not only bringing up the efficiency, but also bringing down the error rates hugely, and the turnaround times being much faster delivery to the customer. So even in our space, we are seeing huge benefits of digitization, and I think the journey will only continue.
Yeah, thanks, Ravi. I think demonetization 2016 end, November, December, we start the first leap of digitization, but it fizzled out after a few months. But now this time, what happened last year, it's only gaining steam. I have actually reams of data, but I don't want to waste our audience's time and your time to dealing out in terms of to prove how fast we are moving on the digitization track. Let's hear other two. Maybe you give us some anecdotes how things have changed for the customer's life or yours life with something interesting if you have. Wilson, your turn, and then finally we'll have Deepak. But Wilson first.
Yeah. On digitization, as I said earlier, it has become a compulsion, something everybody has to go for it. I will give you an interesting piece of information. When we analyzed our data, we have seen that the digital transaction share in our semi-urban and rural branches are slightly higher than the urban branches. This giving a lot of importance and confidence to rural economy or rural customers or semi-urban customers. Something digitalization, we all thought it is very difficult in rural area or Bharat. It is difficult that India like that. But the statistics or the records prove that it is not that difficult. Rural India also is very keen on going digital. So it is going to be a revolution. That's the future of the bank. Even in our bank also, we have seen significant increase in the percentage of digital transaction. And if we take the individual transaction, keeping apart the business and corporate, it is about more than 90%, 92% last month data. 92% of the individual transactions are taking place through digital modes. It is mobile banking or internet banking or any other way of digital banking. So that is increasing, and there is scope for expanding it to other areas. We can take it to decision making, lending, end-to-end loan processes, loan approval, sourcing, processing, approval, and delivery through digital channels. So this all happening, it's all started. So it is going to change the way we are doing banking now. And as a risk manager, I should admit that the other side is giving some concerns, care for a risk manager. The other side is increased cyber threats, data security threats, and all that. So our work is going to increase with the digitalization, cost efficiency, everything, more business, everything. That is the positive side of it. But it is giving way for more cyber risk, data security.
Thanks.
We have to spend time, energy, and a lot of money for that aspect.
Thanks, Wilson. It's great to know that a bank like Federal Bank, 92% of transactions are digital. Like when we talk about the digitally savvy banks in India, your bank doesn't feature there. There are a few other banks we normally talk about. But in case of your bank, you are saying 92%. It's a great number. And of course, the other side is always the threat of cybercrime and all. And I'm sure that's the the business standard series of 5 events is on that. The how to de-risk the system, how to learn things. Deepak sir, your turn very quickly on digitization. You are on mute.
Sorry,
Yeah,
I was
please, quickly.
Just 2 words. Necessity is the mother of invention. In the lockdown stage, consumers had little option. In fact, and people were so much scared of the COVID that everyone was preferring contactless transaction in all the fields. No one would have imagined that your vegetable vendor will just drop the vegetables at your doorstep and request you to pay by Google Pay or Paytm or some other means of digitization. So in that context, in fact, Aadhaar-enabled payment system coupled with the NPCI's gateway, these have created a massive infrastructure in the country, and everyone has got the benefit of that. Of course, banks within the technological framework and the security aspects, cyber security features, everyone has started routing the transactions through or accepting the transactions through these channels. A lot of applications has been developed in the market, integrated with the banking system and the payment system, both connecting the two systems in many areas. And that has run that is going not only in the COVID era, but a long way to in the coming times. It is going to help us in the economic growth.
So it's an era of alliances, bank plus tech, your partner, technology partner. And thanks to Reserve Bank of India, India is the most happening place globally when it comes to the payment space. So quickly, I would like to ask you, each of you, even shorter time, because we would like to take a few questions later and all. This is slightly technical. This entire COVID era, if era is too long a word, a COVID year, let me correct myself, is this, has it affected your decision-making process? Credit decision I'm talking about. The credit decision and underwriting and early warning system in banks, etc. How do they work? I'm sure it has changed dramatically in the past 1 year. Let's start with Ravi this time. Credit decision, underwriting, early warning systems in the COVID period, how things have changed?
I think so. I think a lot more dependence now on technology to take some of this decision. A lot more data analytics. We're using a lot of data. I'm sure same with all other banks. Business intelligence, analytics to see how
Ravi, can you just de-technicalize and tell us little beyond data analytics and all? Now, give an example, like how do you do it and what's the result of this? That kind of thing each of you will ask you, instead of just talking about data analytics and robotics and artificial intelligence. Going beyond term, if you can explain little bit here and there, it will be nice for the audience and for me to learn.
Someone like if the behavior of the customer, we will look at his payment record and see from my analytics, I can actually take out the list of customers where we feel there's a problem and where we can early approach them and say, look, there is an issue, and understand that and see what we can do about it. Also relying quite the credit bureau information, where there are tools where we can take out a lot of information in terms of not just the credit information, but his GST, his tax returns, and collating all that. It's helping us make a decision. Combined with the market research which we have in a particular sector or a particular region. For example, is a borrower over leverage in a particular state? If so, what do we do about that? So we take all these factors in while making the decision, and making the whole a large part of retail credit as a program driven, using technology as a program driven, so that you do faster thing, and stress testing the portfolios quite frequently to ensure that where we are on terms of our loss portfolios, etc. And whether you need to sort of make some decisions in terms of the portfolios. So I said, a lot of in COVID time, we did use a whole bit of technical analysis, analytics, and the business intelligence, of course. I would say the most important piece of the bank for a credit analysis now is the business intelligence, which generates those reports for you to analyze the behavior of the customer and see where we can extend credit.
Thanks, Ravi. So location-specific data and then the credit bureau numbers and everything else and continuous stress testing. Yeah, Rama, your take on
So I think we use a lot of the validation techniques, GST, as Ravi mentioned, GST was one important data. PF, payment of PF, there's a lot of public data that's available and service providers give it to you so that you know that an MSME is working, have they remitted their provident fund use. For example, in vehicles, Vahan is a website where we can go and check what is the vehicle usage, whether the vehicles are registered. So we've used a lot of technological, for our retail customers. On the wholesale side, we have looked at concentrations on the corporate banking side. Wherever there are concentrations, we have tried to de-risk our concentrations. For example, lease rental discounting could be an area where you will find that there, offices are not being used, the offices are being vacated. So you would, change underwriting standards to tighten the norms there as to who you would underwrite for, or would you reduce the exposure in a particular sector? If you look at gems and jewelry, would you look at the export potential? How's the business doing? So in each area, the underwriting standards have been changed. Extra validation has been brought in, and all risk managers in such environments go into their shell. They become extra cautious before doing. So finding that balance and giving them the adequate comfort that you can continue to businesses for the business teams to establish, and you give them the adequate tools for them to take. Because if you look at credit bureau data, just if I may take an extra minute, credit bureau data is not reliable at this point because there was a moratorium given and there was a RBI dispensation that said do not classify non-performing assets. So for the last 8 to 9 months, the data is very disrupted. So that data will not give you the right picture today. It may take some time later before you get a picture. So now you're going by your own records and your additional checks that you do to be able to lend.
Thanks, Rama. Actually, it's a very, very interesting and useful input. Because of the moratorium, how credit bureau data is not exactly what you look for, and you find the right kind of cues. Yeah, Deepak, quickly. You are on mute, Deepak. I think some problem with Deepak's end. Yeah. No. Yeah. Wilson. Yeah. Wilson. Tell us quickly.
I'll tell you one area where we use data analytics very effectively during this COVID period. That's for collection and recovery. Because of the lockdown and subsequent COVID-related disruptions, we were not in a position, we or our collection agencies were not in a position to go out and meet the borrowers physically to tell them to remit installments on time and all that things. So what we did, we used data analytics, our own internal data and the data we had taken from the credit bureaus, their behavior with us, their behavior with other banks, and some alternate data also we used. And based using all this data, we developed some behavioral models. That models we used to predict the behavior of the customers with regard to loan repayment. So that we used in designing our collection strategies that we find very effective. This data analytics, we could, this is one use we find very useful during this COVID period. I am just sharing with you.
Okay. Yeah, thanks. So, Deepak, are you on now?
Am I audible?
Yeah.
Am I audible?
Yes, sir. Quickly, tell us.
No, just quick, I have slightly, in fact, whatever my colleagues have shared, may be true for the retail space, yes. But what I feel now, this is the time where we need to go back to the basic fundamentals of credit. And while picking the customers, we need to go beyond the numbers and behind the numbers, what the play is happening. We have to understand the business models before taking any credit call, because the slowdown of economy consequent upon the COVID has broken many business models. And broken business model has in fact put lenders in a position where it has become a no exit play. You can't exit a customer when their business model has got broken. And this is leading to another risk, that lenders are not taking any risks. Everyone is now looking at only highly rated customers, and many of the customers are losing the access. So we must go back to the fundamentals, in my view, and go back to the days where we are working with the numbers without any much of the analytical tools and applying our own mind behind the numbers.
Thanks, Deepak. Actually, you have touched a raw nerve of the banking system, because the regulator feels and the government feels that you are risk averse. And if you ask the bankers say, no, there is no good, there is no people, not too many credit-worthy borrowers around. But that's a separate story. Let's hear Jitesh. How do you see the credit, the credit decisioning process? How has it changed in Indian banking system past 1 year? Jitesh?
Yeah, so when we see it from an Indian perspective, a lot of conversations which we are having with the bank is on automating the credit decisioning process. So, a lot of times it has happened that we had sold our credit scoring technologies to bank. They were not using it to that extent. And some of the banks were heavily using it. So what we are seeing is they are modernizing to new AI ML technologies, upgrading their analytics platform. And there's an increased focus of users of analytics, as Wilson sir said. And what we are seeing is you're applying analytics to credit decisioning, you're using all forms of data. You're using external data such as credit bureau data, vehicles data, and definitely the behavioral transactional data. The other things also what we are seeing from our perspective is when you're doing a portfolio management, and I think so some of people stressed upon it, you're using business analytics. We are also seeing the usage of deep learning and algorithm in, business, portfolio management. Similarly, on early warning system, it's not only rule based. We are using other forms of data such as GST, which other panelists maintain, and also advanced analytical techniques. So we do see an increased usage of analytics, automation on the credit decisioning side. That's the kind of change which we have seen, and COVID has accelerated that change in an Indian market.
Thanks, Jitesh. We'll come to the last round very quick, and then we'll take many questions are coming. So at least to be fair to them, we'll take a few questions. Some of them have already been discussed. Some of them are aimed at particular entities, naming them. So we'll avoid them, but we'll take at least few questions. But the last thing is, I'll ask each of you to tell us your thing. Say, Reserve Bank of India's half-yearly health checkup, which was the last time came up. The projections was much higher NPAs. The real NPA by March 31st, 2021, the financial year which we ended, it will be far lower. Bankers were very confident, and their actual real NPA and the pro forma NPA was very close. And my understanding is this will see about 2 percentage point increase, so which is 7.5% to 9.5%. It may not even touch double digit. So that was the scene as of March 31st, 2021, new year and the new wave of COVID, and things are getting from bad to worse. So each of you will start with, who should we start with? Maybe Rama, you can start with this. Very brief, one minute comment is in all. Where do you see, what kind of stress do you see banking sector in the coming year? And how long it will take to recover? Rama, over to you.
So going into the financial year, I think banks are provided adequately. If you look at last year, why it softened, because there was adequate liquidity. The Reserve Bank had given certain forbearances through restructuring, through moratorium, FITL, etc. So, and then the GECL, or the emergency credit loan, as you mentioned, 2 trillion of money was available in the system. So that softened the impact. So that we'll have to watch through this year how those borrowers who avail these facilities perform, and that's something we're closely looking into. But carrying adequate provisioning, I think banks have created adequate provisioning to take the impact. If this impact is only for 4 to 6 weeks, I think the impact may not be as material, and banking system may manage well. But if it goes to about 3 months or so, depending upon everything, then there will be again a lot of talk from industry asking for benefits and others, and banks will also have to then look out for what forbearances may come through. So it's a question of how fast will vaccination happen? How quickly will this second wave subside and go away for good? So it's a difficult job, because again, we have to look at stress tests again. And this stress test looks even more difficult than the last one, because you have a lot of data and still you don't know how long this is going to last.
Deepak?
Personally, I feel this second wave of COVID should start wearing out by the third quarter. After September, because by that time, my feeling is that most of the people will get vaccinated and remaining will get either infected mildly or severely. They will get infected. So everyone will be having more than 50 or 60% of the population will already be having immunity enough. And after that, it is expected to decline. So this year may be a bit struggling phase. Economies should come back in the next FY, in my mind. This is my
Is Wilson?
presumption.
But third quarter, it's quite a long time. I mean, long stress. Yeah, Wilson around? I can't see him. Is he there? Wilson, we can't see him. So Ravi, your take?
Yeah, it depends on, I guess, how long this pandemic continues. We see the vaccination picking up now. I think already 10% of the population has been vaccinated and maybe 10% of the population has been infected. But once the vaccination picks up, so say beyond 20% of the population, I think that's a good sign. And the bank's NPS is a function of the economy, how it does. But even now, we see some of the sectors like, say, pharma, automobiles, aluminium, steel, they're doing pretty well. So I think there are no issues there. But the government has reiterated several times that there's not going to be a national lockdown, but it's more going to be local lockdown. So I don't think the fear of a complete shutdown of the economy is going to happen. My own view is if the vaccination goes on at a pace which they're trying to drive, probably we could see economy improving in earliest by June, and then there can be a catch-up on that. There's no problem of liquidity. Banks have liquidity, and banks have made adequate provisions for the NPL, so there's no issue on that. So basically, liquidity and capital, if it's taken care, I think we could see banks, the economy picking up and the credit offtake taking place. As I say, as early as June, we could see the.
Thanks, Ravi. Mr. Viswanathan, I can see you. Can you hear me, sir? I know you are a keynote speaker. You are not a part of the panel, but since we are talking about the stress and this is the last round, before I bring in Jitesh for something else, as a former central banker, can you give us your 1 minute? How do you see the stress in the second wave? Because we have done reasonably well, in fact, better than what people had expected, regulator had expected from the banking industry, be it provisioning, adequate provisioning, raising capital, and keeping the NPAs low. Now, the second wave of COVID, Mr. Viswanathan, what do you feel about this?
So, of course, I was not really in the sector, so I'm going to what's available in the public domain. But I think very importantly, I want to begin with what you said in your opening remarks before the panel discussion started, which is that prior to the COVID setting in, actually the Indian banking system had acquired almost strong good health, because of several actions that were taken by regulator and the government to recapitalize the public sector banks. So many of the public sector banks had also come out of the PCA framework because the government gave them the required capital, the provision coverage ratio increased. And I thought, had it not been for COVID, we would have been in an entirely different plane today. Okay. So in a way, therefore, the readiness prior to the COVID onset to deal with risks that were there till then is something very important, I think, element in enabling the banks to weather the storm of COVID, the first wave. Okay. But I also, I've seen general, I think, rating agencies reports which say that the banks are much better prepared now to deal with the outcomes of the second wave than they were to prepare for the first wave. And hopefully, between the prophecies of Mr. Deepak Kumar and Mr. Ravi, I would want Ravi's prophecy to come true, which is that we are, getting out of COVID sooner than in the third quarter. And I fully agree with both of them that how much the stress is a function of how soon we come out of the stress. I mean, how soon we come out of the COVID. So it's extremely difficult to evaluate in terms of, measure that in terms of, what is going to be the extent of risk. But I see that, at least on the basis of available reports, the banking system is perhaps a lot better equipped to deal with it.
Thanks, Mr. Viswanathan. I was just dreading that the central banker in you would tell that don't ask for any concession, don't ask for anything, just fend for yourself.
That have already said in my.
Yeah, Wilson, we missed you. We are talking about how deep will be the stress. Just one line from you.
Tamal,
yeah, I just said we are discussing the second wave of COVID. We have done well. We meaning the banking system has done pretty well on the first wave. Now, second wave, how do you see the stress in the banking system? How deep it will be? Just one sentence.
Just as somebody mentioned, I think somebody mentioned, for next 2 quarters, nothing to be afraid of. Even if the COVID is there, second wave is there, Q1 and Q2, banking system can survive very well. Enough provision is there, enough capital is there, and everything is fine to survive 2 quarters without any problem at all. I am very sure that the problem will cease much before that. With the vaccination progressing, things will improve. I am very sure that this is not going to be a permanent issue. This is a temporary thing. That is my wish and my hope. And I am sure banking system won't be impacted as like some other heavily impacted sectors.
Very heartening to hear that. Jitesh, your turn. Tell us, no, forget stress and other things and all. What is the new normal for Indian banking system against the context backdrop of COVID?
I'll again go back to my earlier answer, and where we stated, though we hope that things will improve over 2 quarters, but the experience with pandemics in the past, you have to be optimistically cautious. Yes, vaccination will increase, it will lead less infection and probably normalization of economy. But what one should plan for is this may continue. That means how fast the vaccination is, how fast the mutants are evolving. So a risk manager will always prepare for the worst. Having said that, I do sincerely hope that it all normalizes. So as a risk manager, always we need to prepare and we need to take into account. And from a perspective of looking as a new normal, as I stated, this COVID has induced long-term changes. And some of the key themes which I talked about earlier is going to sustain. Transforming the customer experience, use of analytics, movement to the digital channels, cost optimization, cost efficiency, automations. These are bound to say use of analytics for decision making, using the plethora of data which a banking institution has for making decision making in all spheres, not only on the risk side, credit decisioning, customer lifecycle management. And what we also see on the risk management side, where we talk of the stress, whatever extensions have been given, how they behave. That's a big uncertainty right now, how it will turn out, how it will behave. And the second thing is, though some of the banks are well capitalized and they have good asset qualities, some of the banks do have asset quality changes. And now if you look in terms of when you harmonize and when you migrate to the Ind AS 109 or IFRS 9, some of the banks will be impacted by those provisioning norms. And there would be capital requirement in certain section of banks in India. Having said that, there are banks which are well prepared to take that stress, but there are banks which will get impacted by this stress and will require capital. That's how we see the situation evolving from our.
Thanks, Jitesh. Thanks, Jitesh, for your very balanced approach and your cautious optimism. We are just coming to the end. We have 2 minutes left, and we'll take 2 questions. One question is for everybody, and one question I'll ask just one person. There are many questions. I wish we had more time, but we budgeted till 5:30. So this question is from Devanshi Ruparelia. How will this financial stress affect job opportunity in financial sector, particularly banks? I think let's hear Rama, because you are the largest employer among all of them. So do you think that actually there'll be more job opportunities because of your emphasis on machine learning and analytics and AI and so on and so forth, or less job opportunities Will it shrink, or will you meaning not IndusInd Bank for the banking system?
So the banking system whole, I think because of all the digitization, the overall hiring number of people may reduce, the skill sets may change. So banks will may have data scientists, so they'll have to hire people who are, in different verticals or specialize in IT verticals, and may reduce on the large volume of people that you have at a branch. So my view, I think it will reduce the number of people in an absolute term, but the kind of skill sets which are required for banks may change, and you'll hire in those specialized verticals.
Thanks. This is one question, because we just 5:30. I would like each of you answer this, and including Mr. Vishwanathan sir, if you do not mind. And you'll be the last one. We'll start with Ravi. This question is actually, there are many questions, and some of them are very interesting, but for want of time we can't. This is Sridhar Srinivasan is asking, what will be the top 3 risks that Indian bank should prioritize, should face in terms of priority for the fiscal year 2022? Top 3. Ravi, it's starting with you.
I think I think that's quite clear. One is, of course, the cyber risk. So information security risk, I would put it top there. Number one risk is information risk. Second would be the whole credit risk in terms of how it will shape up and what it will happen. And third, I would put it as fraud risk.
Okay. Cybercrime, credit and fraud. Wilson, 3 key risks. If you want to expand the list also, you're welcome. But 3 in terms of priority.
The main risk, as it is always the credit risk, in my view, asset quality is the main risk we are going to face, particularly in this situation. And second, the data security and cybercrime. Of course, there is more chance for more threat from that side. And liquidity also. Once this excess liquidity is absorbed or wiped away, there will be a liquidity risk also. Banks should be aware of that and keep their eyes open on that front also. So that's very cyber security and liquidity.
That's very interesting. Once Reserve Bank of India start unwinding, the liquidity risk will come for the bank. Yeah, Rama.
Yeah, I think I also agree. Credit risk should be the number one because, the pandemic and credit quality. Second will be information security risk along with cybercrime because of digital operation. Third is, I think liquidity risk, as well as I would look at operational risk also, because operational risk comes along in certain form because you're depending a lot on systems and, remittances and others that reach a lot of operational risk parameters. Liquidity is maybe not the top 3, but if RBI unwinds or there is a liquidity crisis, that would become a particular. Today, I think banks are adequately liquid. Maybe for the year, they will manage it in my view.
So, Jitesh, what are the top 3 risks for the Indian banking system?
So, definitely credit risk and how this pandemic affects your credit portfolio. That is the top risk. But one other thing which comes to our mind and which we see is employee safety and security, business continuity. How do you keep your employees safe and how do you manage to run your operation? And the third thing we see is increased risk of, cyber security risk or cyber fraud risk. So these are the top 3 risks which we see from our point of view.
That's very important, Jitesh. It's a very important, the human factor that you spoke about. How do you keep your employees safe? Yes, Deepak?
To me, in fact, credit risk coupled with the model risk, I would say, and the cyber risk. And third is again the human capital that, in fact, Jitesh was mentioning. To my mind, human capital is another risk area where I am foreseeing. Because people are getting psychologically impacted more by the COVID than the physical impact. And that psychological impact may affect the whole scenario.
Thank you. We are fortunate and privileged to have Mr. Vishwanathan all through, and I'm taking advantage of his presence, sir. So I want you to have the last word, being a central banker, and now you are chairman of a very critical division of the Reserve Bank of India. Tell me, in terms of priority, what are the 3 key risks in fiscal year 2022?
So, let me put it this way first, that generally there are 4 groupings of risk. Okay, so you have credit risk, then you have market risk, then you have operational risk, and then you have the liquidity risk today. Okay, so everything will fall within these 4 categories. And I think given in terms of the impact of the pandemic, credit risk is going to be very crucial, because how the asset quality will behave going forward will have a huge impact on the balance sheet of banks, number one. The second is, as I said, operational risk largely coming from digitalization, increased use of cyber channels, and therefore the threat to data breach, cyber risk in general. Third, I would kind of within the operational risk, you have the staff risk in form of business continuity, etc. So it's a sub risk within that. Third, I am a little also worried about market risk. So how the interest rates will move forward. Are the banks ready to take that risk in case there is a surge in yield? Is something that I will be worried about. And liquidity risk, I think, will not come. If you look at even in the worst of times in the crisis, the Indian banks have not faced liquidity risk, because I think we had an SLR system which was much better than the LCR, which the Basel Committee invented later. So liquidity risk, and I think RBI has the capability to manage that to a large extent at its level. So individual banks may have to look at from their perspective, but in terms of system risk, I would say how the credit portfolio behaves. Within the credit portfolio, there are two large segments for me. One is the retail sector, the other is the corporate sector. So these could have different behaviors or identical behaviors depending upon how the pandemic kind of turns out. So in order of priority, I would say credit risk is always the biggest risk for me. In the current wake of things, the operational risk, and then market risk and liquidity risk in that.
Thank you, Mr. Vishwanathan. There are many questions. One from Girish Jaswani, then Parthasarathi Roy, Madhav Sharma, Pratik, Pratamay Majumdar, Charudatta Sharma, Avilash, Manish Ved, Dinesh Rana, Joshili Shastri, Prashast, Parthasarathi Ray, many more. So my apology to all of you, those whose names I called and those whose names I have not. But thank you for being with us. I think it's quite exciting. We could have gone on for another half an hour, but every good thing had to end. So what are the key takeaways? We have heard RBI Deputy Governor in his keynote address, and also he was gracious enough to participate mildly for a few minutes on certain issues. We have heard the four bankers, Ravi, Deepak, Wilson, and Rama. And also we have heard a sort of data risk, global firm which is into data analysis and AI and machine learning and all helps the bank and all. So what's the key takeaway? It's a bad time, but everything is not lost. Our financial sector stability is not at stake. Banks are adequately capitalized. They have provided for. Adequate provision has been done. So it's not as good as before COVID we were, but because post AQR, they are in a pretty good shape. That's why they have been able to withstand the shock. And now we need to see how it's essentially a medical problem, a non-economic problem. Again, the second wave, which is far fierce. So we need to see how fast we tackle this from the angle of vaccination of people, etc. So the shorter the phase, the better. But right now, everybody is cautiously optimistic that we will overcome this problem also. But the structurally, both the structure and the soul of banking is also changing. The new normal is more dependence on data analytics, on machine learning, on everything that you need to do, and increasing digitization. So both for the customers and the bankers, it's a sort of new world in India. With this note, I call the curtains for the first phase of in Business Standards 5-part event. And over to Manish. Thank you all.
World.
Stay safe.
It's a new world indeed, Tamil. Many thanks. Speakers, you have set the course for this event series. Thank you, SAS, for partnering with us. And dear audience, thank you for being with us today. Remember, we are just getting started. We have 4 more sessions to go in this webinar series. The next session is on Tuesday, 27th April, and we go on for 2 more weeks. Every session will be at 4 p.m. Those who've registered with us, you can log in and watch all sessions. We look forward to having you with us. We'll sign off with that. Please stay safe.
Thank you.